Today we have Greg Corneille. He is the founder of Choice Wealth Management, which provides active management and comprehensive wealth and retirement planning in Atlanta and nationwide. Greg, welcome.
Hey, thank you, Asher. Thank you for having me here.
So I always like to start off by looking at the NAAIM Equity Exposure Index. Pull that up here. And this week came in right at around 94, up from 89%. And that represents an average of NAAIM members who contribute to this index, meaning that they have about 94% exposure to equities. It's pretty high. It doesn't usually get this high, so a lot of optimism in the market. Greg, what's your take?
Yeah, I mean, it's interesting, and we were talking earlier. I don't know if there's a way to layer, or if there's a way that the NAAIM Exposure Index can populate in a stock charts. I know it doesn't in TradingView, but layering that against something like volatility or the VIX, because I think in my observance and being a member of NAAIM for I guess the past 3 or 4 years, that's kind of the main correlation I've seen is that when volatility starts to uptick, that's when you start to see significant declines in the exposure index. Right now, we're making multiple all-time highs, and so I would expect it to stay in the 80 to 90 range, for some time, as long as that type of thing is going on.
That's interesting. I feel like everybody's got a different way of looking at this. Last month we had Rob, who ran kind of a quantitative trading model. This is the first time I've heard about comparing with volatility, so we'll definitely have to keep an eye on that. We can see below here, it's not quite an overlay, but that is a chart of the S&P 500 here, and it's been going up right alongside the NAAIM index being in an optimistic zone. So I guess it's a good sign.
Yeah, I think there's probably an average range of 70 and above, and that's probably if I was to use it in any kind of a strategy implementation or looking for any kind of a confirmation, it would probably be around like figuring out like a range for it to be in, not necessarily to follow it up and down, because as to your point, there's it's different types of managers, right? And there are different types of strategies with different types of objectives, and so it's not going to correlate 100% to the S&P, but I try to look at I just try to note like the range, like if we get to kind of below 70 to 60%, that's kind of where it's probably meaningful from a signal standpoint.
Okay. Yeah, oh, that's great. I think it's fascinating. We'll just keep looking at it every week. So what did you? Let's close this. What did you see in the market last week?
Well, more all-time highs. Generally right now, and we'll get more into obviously strategy, but I look at it from a standpoint of whether it's technicals or whether it's just measuring momentum. Whatever happens in the news is going to show up in the charts sooner or later. So I'm not I'm not necessarily going to be big on speaking to economic analysis, but I do I do look at the fact that when we make a new all-time high on the S&P, as we did back in I think it was mid-January, for the first time after not having made one in over a year, the forward trajectory from that point is generally pretty strong. So that's kind of generally speaking where I think we are right now. but again, it doesn't necessarily dictate, day-to-day management of the strategies that I run.
So when the market's trending up, it's usually close to an all-time high, and that's kind of where we are right now.
Yeah, yeah, yeah. I mean, that's pretty much where we are. I mean, we're in an election year. The market's usually positive, usually strong in election years. I think, seasonality. I follow seasonality pretty closely, and so I think we're going to probably be trading sideways, for the next 2 to 3 months, before having kind of more of an uptick in the fall as we get closer to the election. So yeah. Yeah, just kind of a plug for the NAAIM webinars that we do. We had the folks from Season X that actually did a great webinar a few months back, I think it was. And for our members, that's available on our in the archives. But stuff like that is real interesting to me, and I find it to hold true more often than not. So yeah.
Absolutely. Yeah, I remember they had some good rationales as to why seasonality would still continue to hold, or maybe even get stronger, even if everybody is aware of it.
Yeah.
So all-time highs is something you look at. Can I ask you about your investment process? You're, as a member of NAAIM, you're an active manager, but there's 1,000 different ways to do it. So
Yeah.
what can you tell us about your style?
Yeah, absolutely. And would this be a good time for us to go ahead and share some visuals here?
Yeah.
Let's see. Give me just a minute while I drum this up. And all right, so okay, are we?
Yep.
Yep, we're running. Okay, cool. All right. So yeah, this is just a kind of brief little walkthrough of our investment process. And at a certain point here, I'm going to switch out and share share some charts and share one particular thing that is of importance to me. But why active management? I mean, we're all believers in active management, and really, I mean, if you if you talk to the kind of the buy and hold crowd, and they'll kind of notate the long-term returns of the market in even a buy and hold scenario, and that's great, but you just have that wide deviation of returns, and so if I'm serving a client, and I were to say, hey, we've got a chance over the next 10 years to make 18% as would happen from 1990 to 1999, the S&P 500, or we could be down 1.5%, on average, right? So who knows what that cumulative return is. So for somebody that has a 10-year window, let's say a 10-year window to go to retirement, that's unacceptable. That's unacceptable to have that kind of risk. And so I look at buy and hold as really kind of a risky proposition from an investment management standpoint. Not because of the long-term annualized return, but that's a 72-year period. So anyway, obviously, active management is what we're proponents of. So one of the questions I know that you end up coming to is one of my favorite investment quotes, and it's simply that the Oracle of Omaha, diversification may preserve wealth, but concentration builds wealth. And whether that's concentration in an equity, in a specific equity position, or just in your asset allocation, right? So we can be 100% in equities, right? That's okay. We can be 100% in fixed income. That's okay if that's what our strategy calls for. So yeah, I'm a big believer in this quote right here. So
That's a great one.
um,
Somebody actually told that to me yesterday.
oh really?
Yeah.
Yeah. Mm. Yeah, it's true. And one thing, and I don't have the visual here, but uh, the 80-20 rule, the Pareto principle, you know. So if we were to look at all the returns of the S&P 500, you'll find that over the long term, 80% of the cumulative return is made in 20% of the years, right? And then the opposite is true. 80% of the losses come in 20% of the years. So yeah, going back to active management, if we can make any efforts to reduce or eliminate exposure to some degree during those 20% of the years in which we're most likely to lose most of, to incur most of the losses, that has a big effect on not only the long-term average return but also the standard deviation. So.
That's right. Not everybody has the long term to wait.
Well, no, I mean, none of us have 70 years, right? Like, if you're investing money today and you've got money to invest, if it's yours, and if it's inherited, it maybe, but it's yours, more than likely, you don't have a 70-year window to get it right. So, uh, but, getting into the strategy, it really starts with these kind of simple stock market truths that I believe that these are form kind of the foundations or guiding principles of our strategy. And so the first thing is the stock market is up most of the time. That's just the truth. It's up, on an annual basis, 80% of the time, right? And so if so our strategy should be congruent with that. Now again, different strategies have different objectives. I understand that, but our strategy tries to be congruent with the fact that the stock market is up most of the time. So in essence, in the absence of other mitigating factors, we are going to be fully invested. Okay. In general, the stock market rises slowly and falls quickly. Okay. So that speaks to volatility, right? So we'll get more into that, but the volatility assessment plays a big role in this. And then it's impossible to, some may disagree, but it's impossible to accurately time the market 100% of the time. And for me, that just means that when we get a signal, there should be some mechanism to wait for confirmation or to try to get confirmation of that signal, because you can get a signal all the time, and any signal, I don't care what strategy you use, what strategy you use, what signal you use, nothing has 100% accuracy hit rate, right? And so when we get signals, there's a component of our strategy in which we try to seek confirmation of those signals. Okay.
Nobody can time it 100% of the time, but it doesn't stop some of us from trying.
Yeah. My crystal ball is broken, so I always kind of lead with that. So here we get into like the factors, that really kind of play into it, and some of the allocations. So for our strategies, and we run two strategies that just kind of have different risk profiles, but the primary three factors that we consider are momentum on the momentum over the previous 6 and 12 months. So it's basically 120 and 240 days. Volatility, and then drawdown on the S&P 500. So drawdown is self-explanatory. Momentum, again, of 6-month and 12-month momentum. Volatility is where I'll kind of, spend some time talking about, because there's a lot of different takes on volatility. So I'm going to go ahead and skip ahead to, well, maybe what I'll do here is I'll show my chart here. How's that? Can you see my chart, trading view?
Yep.
Okay. So in terms of volatility, the thing that I look at that I found that's been very effective is the 5-day rate of change. And so what we look for is periods of time or days when the market has fallen 5% or more over the previous 5 days. Okay. So, and I kind of notated those points. I think there's 18 points in here going back to 1990. And I should also say these are instances where the market has fallen 5% or more over the previous 5 days without having done so in the previous 90 days. Okay. So there are times, for example, during these, bear markets in 2001, 2002, this happens every other week, right? So we're not counting those, right? So, but what you see is that there's only 18 occurrences over the past 34 years or so, right? And you see that there's wide ranges of times from, late 1990 to mid 1997, where it didn't happen at all, right? 2000 through 2007, right? Didn't happen. And then, we had 2007 through 2010. Then we went 2011, July 2011 to August 2015. August 2015 to February 2018. And so what you can quickly kind of ascertain is that, there's some of these really low volatility years, like 2017, really strong years, 2017, 2021, 2013. You didn't see this type of thing happen at all. And so, obviously you're not getting that kind of, bear market or down signal there. So, it can really serve to kind of keep you fully invested during times like that. All right, so I kind of summarized it here.
Oh, I was just going to say it's such an interesting indicator. On the chart, it looks like, it's really good at picking out when the market collapses. But if it doesn't collapse, at least you have plenty of time to reestablish your position before it continues upward again, or to look for other confirmation signs. So it's like when one of these happens, you don't have to worry about the market running away to the upside. It gives you time to breathe, right?
Yeah, I kind of look at it as clouds in the sky, right? So it doesn't mean it's going to rain, Now it could rain, it could thunderstorm, it could be a tornado, who knows? But it's clouds in the sky. Could be nothing. I mean, it's a cloudy day right now, but it hasn't really rained, right? But it makes sense that if I'm going to leave the house, I should probably have an umbrella if I know I'm going to be outdoors. And so that's that's kind of the analogy that comes to mind. And yeah, I mean, it happened prior to these big signals, and I probably should have kind of put these in red, but November 2007. We can go back to October of 2000, right? So right before these huge here, and then right there at in February of 2020, right? So and then in January of 2022, right? So yeah, again, it's part of it's part of our overall kind of formula, if you will, to suggest that, hey, this is a good time to to start reducing exposure. And I kind of summarized it here. And so again, this happened 18 times from 1990 to 2002. 1 year later, the market was higher in 66% of the time. All right. And that's compared to 79, almost 80% of the time in terms of 1 year rolling periods from 1990 to 2023. Right. So, and again, more importantly, you kind of look at some of these some of these 1 year periods there that it kind of helped to, at least avoid to some degree. And then also the average 1 year return, 6.9% compared to 8.7% in the 1 year rolling period. So, yeah, I mean that's my take on that's at least how we incorporate volatility into our strategy.
Oh, that's great. That's looks like a really important indicator. And it reminds me, there's another, there's a white paper that won the competition at the NAAIM Knowledge Conference last year, called the 5% Canary, and it analyzed how the speed of a 5% drawdown can predict how severe the rest of the next market action will be, and the faster the faster it happens, the worse it is for the market. Like, so 5 days would be a fast one, but
yeah,
if that gets
I
drawn
haven't.
out over a while, it's not so bad.
Yeah, that's interesting, and it would be interesting to kind of play around with the number of days it took to get to a certain point, or even okay, if we saw a 4% move to the downside over 2 days, right? So something to incorporate the number of days as well as the drawdown would be interesting to see. So yeah, but yeah, again, it kind of, I kind of try to account for the a lot of the different variables that could occur during the market. Momentum just kind of gives you where we're at. The volatility and the COVID was a great example of the volatility working out, because momentum was high, right? Coming into in early 2020, early 2020, the market was pretty strong in terms of momentum, but then you'd start, you had these, this uptick in volatility, and then of course momentum quickly went negative, but by that time, a lot of the losses have started to occur, and then the drawdown is helpful because there are periods where momentum starts to rise to what we would consider tolerable levels during a bear market, and so, for example, April of 2008, the market started to kind of rebound, and you started to see kind of positive, especially 6-month momentum. But considering where we were in a drawdown, it just didn't make sense to to get too aggressive at that point. So
Bear market rally, indeed.
Yeah. So and then just finishing up, based on our signals, again, in the absence of other factors, we're fully invested. We could take the allocation down to kind of a 50-50 stance, or we could be fully in fixed income and cash, right? So yeah, I think that's, and then let me see. Yeah. Our two strategies are pretty much very similar with the again, just two different risk profiles. We kind of use one strategy we use leverage funds, and then the other are non-leverage funds. Again, just different risk profiles. There are in some instances we will also do sector rotation. Kind of along with these approaches, but this is kind of, these are kind of the general strategies.
What's your outlook? Near term, long in the future? What do you think is going to happen next?
Yeah, again, I do. I mean, we've had quite a bit, quite a nice rally, in these past 4 months or so. That again, I could see. I wouldn't be surprised if there was a lot of sideways action, as we head into the summertime, before kind of finishing up the year on a more of a stronger note. Yeah, I mean that's pretty much where we're at, and pretty much my take on it. Yeah.
Okay, great. Where can we find out more about you and your firm?
So yeah, our website is choice-wealth.com. I'm on LinkedIn, Greg Corneille. Our firm, we have a Facebook profile and Instagram and things like that. And so we try to do a lot of videos. Some are kind of market education, but a lot more of them are more financial planning focused, and kind of trying to speak to the real life financial planning issues that that we work with clients every day on.
Excellent, cool. Are you coming to the NAAIM Uncommon Knowledge Conference in April?
Yeah, absolutely. I'm looking forward to it.
Great. Yeah, that's.
I should get my. I think I should be on pace to get my trendsetter badge for contributing every week to the NAAIM exposure index. So.
I'm looking forward to mine too. Yeah. I see that index used kind of everywhere. Just yesterday, I was talking to another investment manager, and he had a list of all the different economic factors he uses, and NAAIM index was in there. I've seen some pretty big users on financial Twitter quote that index, so it's always good to contribute.
One thing I'll say about I'll say quickly about the NAAIM exposure index is it's interesting, and I kind of had to adjust my contributions to it because that it can get over 100% when accounting for managers that use leverage. And for a while, I was kind of inputting mine, based on the leverage strategy, but or at least when I first joined NAAIM, but I kind of thought about it, and I guess I was like, I think the right thing to do is probably to do it based on my overall exposure to equities, because I could be if I'm 50%, if I have 50% equity exposure in our leverage strategy, putting 100% there would be a little bit misleading. But I know there are some managers out there that will, you literally use leverage, and they might be 100% or have 100% exposure, but then given certain conditions, they might add in the leverage, so it can get over 100%, which I think is again, it's interesting. It'll be interesting to see if it happens this year.
Yeah, I like that about the index. I think other sentiment indices kind of range between 0 and 100, but this one it can even go negative if everyone's short. I think that's great. As long as we have a consistent methodology, that's what counts. So I'll see you at the next conference. It's the NAAIM Uncommon Knowledge Conference, April 28th to May 1st in Orlando, Florida.
Absolutely. I'm looking forward to it.
Me too. All right. Well, that's it for this episode of NAAIM Confidential. Tune in next week for Jim Lee, interviewed by Ryan Redfern.
All right.
Okay.
Thanks again, Asher.
Thanks, Greg. Take care.
Thanks.